Who wants to pay off all their debts and have no money versus who would like to pay off their debts and have some money on death benefit? So we're not talking about really any sort of complex process here. It's just simply flipping that switch where that money goes first so it can compound and grow. And then we're going to leverage it to pay down those debts, making your money work for you, right? We're not just going to let it sit in the policy. We're going to put it to work. We're going to deploy it. So welcome, Wealth Webinar family. We've got Jason Sipple and Joseph on here as well. We're going to walk you through a debt pay down example. But before we get started, Jason's going to share with us a little about the debt condition in the country, just kind of paint the picture. And we don't want to be all about talking about just the problem. We want to talk about the solution. So between the three of us, we're going to present the solution. We're going to talk about different possibilities that are out there. So without further ado, let's get started here. I'm gonna go ahead and share my screen out.
All right. A lot of the stuff will be self-explanatory on the slides like this one. This is a fun one, guys. If you don't know about this, go to usdebtclock.org. There's so many, especially if you're someone that likes statistics, numbers, it shows you everything. It shows you median income. It shows you our national debt. You can go in the past and see where it was a few years ago. You go in the future. But what I'm going to ask you, we're going to start with a fun game. So I'm going to ask you guys all, and please type answers in the chat or the Q&A. Let me see if I can get the chat up on my screen as well. There we go. But I'm going to ask you in this fun game, because who doesn't like playing games, right? Where does the majority of America live, right? Any guesses? Just, answer in your mind, write it down. Craig, where do you think the majority of Americans live?
Are you talking physically or mentally?
I mean, I'm just asking the question. You can pick whatever was present to you. I'm going to tell you
the way my area in Colorado is growing, I would say they live in Colorado, but
yeah, see, we got all different. They're definitely not going to Buffalo where Joe lives, right? We got coastlines, we got in debt are some of the guesses. The majority of Americans, they live in the familiar past or the predictable future. Science shows us 95% of our day is already decided before you even open your eyes, pull down the covers, and put your feet on the ground, right? So what we're going to show you today, we're going to set context. We're going to show you what Americans are doing. We're going to show you where we're putting our money. We're going to show you how we respect others first, because we've all been groomed for the most part, maybe not this group, but we've been groomed to be employees, right? To go out and to help someone else get wealthy, to have financial freedom, and have a job that usually just stands for just over broke, right? So what we want to show you is that I have an easy belief. I believe the quality of our life is a direct reflection of the quality of the questions we ask ourselves and our ability to do two things. One, take radical ownership. Two is to take action, right? So we're going to show you not only what the problem is. So Craig, give me the next thing. So right here, we're $33 trillion in debt, right? I believe this is today, right? This is 2023.
Yep, this is today. If you go out to the debt clock, these numbers just continue to go up, but this was a snapshot that we took. So it's going to be bigger if you go out there right now. usdebtclock.org.
And so in 2027, we're going to be $11 trillion more in debt. That's only 4 years away, right? And if we really understand the government and how the government works, right, the two biggest assets of the U.S. government, one is student debt, which is over $1.7 trillion, right? So like I said, we're groomed to have a job, and then we're going to be paying on that debt forever, because the government can only make money in one way. They're not going out and producing things. They're not creating things. They're not doing what we need to do as the 5%, right? Not the 95% who aren't reaching financial freedom. So what we're doing is showing you guys, like, you have to take ownership of this and understand that the government only makes money from taxes and from us, from creating systems that they can have more taxes, right? So if you look where we're going as a nation, we're going more and more in debt, but we want to say, no, let's disrupt that. Let's take ownership of it and let's get out of debt and then build wealth. Here we go.
I threw this
talking about
maybe a surprise. Well, it just backs up the point you're making. So where in part of the national debt, where's the household debt going? We all know that household debt continues to increase. And look, when we go to the store, everything is costing more. The cost of goods has gone up. The gas prices have gone up. So people are getting squeezed more and more, and we're starting to see those credit card balances going up. So right here it says that the credit card balances saw brisk growth, rising 45 billion to a series high of $1.03 trillion. That's pretty large. So I think that backs up kind of the pieces that Jason's talking about with the
Yeah,
national
whenever
debt.
we're talking B's and T's, we're talking about large numbers, billions and trillions, right? And you see, like every day when I go to the mailbox, I get so many offers. Oh, Jason, here, take a loan for this, take a HELOC, take the money here. Like Joe's Mr. HELOC. But every day someone's offering me money because they're making money on our money, right? We've been taught to give up control of our finances. We've been taught to give our money to others. We've been taught to assume the risk, and it's costing us our freedom, right? So this is showing us the symptoms. Like we're really addressing the symptoms right now and where we're really at. So, right, this is the same. This is showing us, like, I thought this was really interesting. It shows us like we got a little better at saving during COVID. Why? Because we weren't consuming. Other than Amazon, I don't know about you guys, but Amazon was at my doorstep almost every day, right? But you're looking at this, look back in, early 2020, a little bit in 2021, our savings was 20, 25, 30%. But on the average for the last 30 plus years, it's been less than 5% as a nation. Right now, we're at like 3% as of this month, right? 3.5%. So that means that every dollar that we make, we're only saving 3.5 cents of that dollar, right? And you can just multiply that, add zeros, add zeros, add zeros. You make $100,000, you're not saving very much, right? You make $1 million, you're still not saving very much in comparison. So where is that money going, right? If you're not paying yourself, if you're not saving, it's going somewhere else first.
And Joe, for all the people you talk to, where's that money going that they do save, that 5%, let's say? Where do you think that money's going?
To the bank for amortization because of their mortgage.
It's at least 30%.
So speak a little more about the amortization. So what do you mean? What's going on there? What's going on with this?
When people get a mortgage, it's amortized. So that means that less is going to the principal and more is going to the interest in the beginning. The bank turns down the volume. They turn down the velocity. So that is the terminology for how quick the loan gets paid back, especially towards the principal, and they're accumulating a whole bunch more of interest. And that's done in the beginning with amortized loans with the bank. What I try to do is switch them from a mortgage to a HELOC, which is not amortized, but simple interest. Now, the people are putting more to the principal than what they were doing with the mortgage. So therefore, they're taking back control because the HELOC they're in control of, and the mortgage the bank is in control of.
And I think that's a powerful point too, because you're talking about, instead of looking at the rates of interest, we should be focused on the volumes of interest, right? So
that is correct.
In an amortized mortgage, I mean, is it fair to say that, say, if you're getting a 7 to 8% mortgage note, that you're paying maybe 70% is interest of every payment?
Absolutely. Absolutely. Because on a 3% mortgage that is amortized on a $100,000 mortgage, you're actually paying back $50,000 in interest over 30 years. Well, if 50,000 is 50% of 100,000, where does 3% come from, Craig? What is 3% if you're paying back 50%? Oh, let's turn that dial almost off for velocity, and that's exactly what you can come up with.
Yeah, so it's a manipulation of the numbers. Again, the volume, for those mouth folks that didn't understand what came out of either of your mouths, all we're saying is that the volume of interest that was over, like, our bank's smart or dumb with what they do. We haven't talked about in this, but something I talk about on a regular basis is where, since 2013, who's the biggest purchaser of whole life? It's the banks. It's conventional banks, over $75 billion. Well, why are they doing that? because it's a secure, guaranteed place to park their money, to grow and to leverage it, right? They understand leverage. They understand how to make their money, the dollar, work in more than one spot. And all we've been groomed, again, going back to my initial point, we've been groomed to give up control of our money. If you go to the next slide, it'll show more of what I'm specifically talking about with household income. We've already showed you the debt. We've already showed you where we're going as a country. Here's our breakdown of patterns, right? So this means that we're giving 20 cents of every dollar to the auto people, 30 cents of every dollar to the housing people, right? 40 cents to everything else, for everything else. And if we can't break this pattern, if we can't beat Parkinson's law, meaning that today, whatever you make, if you can't pay yourself more than that 10 cents, which is super generous, then you cannot escape this pattern. And then even if you increase your income, because we all need to be in two businesses, the business of making money, number one. And then once we figure out that business, we have to understand, how can we be the banker? How are we taking back control of the process, right? We teach a process. It's not I don't know, it's not just the vehicle. It's the process of banking, right? So if we're not able to break this pattern, like even if you add another zero to what you make today, if you still spend like this, I've talked to people making $400,000, $500,000, $600,000 a year that could not pay themselves $833 a month. How can you ever possibly change your pattern if you don't see what's really happening?
Well, Jason, I'd just add one more piece to this, because Nelson Nash talked about this as well, where that 10 cents that we're saving of every dollar, that's going into oftentimes high risk areas. We're trying to accumulate and build nest eggs out of that, right? And if we start focusing on that other 90% that we're spending, what would that do to our personal economy if we were able to keep some of that, right? Yeah. So we not only want to look at the 10 cents we're saving, but how could we be more efficient with that 90 cents we're saving of every dollar, or we're spending of every dollar? But Joe, you were going to say something.
And of all of these things we're shown down here, like Joe was saying in the last example, of that housing, right, for the first 5 to 7 years, because again, the banks have been doing this for a long time. They're making 4 to 1,500% or 4 to 1,400% of every dollar we put in. That's what they're making off our money, right? So they know we move as Americans every 5 to 7 years. So you're paying almost 70 to 80% of your mortgage. Like I looked at mine when Chris said this the first time, and I went and looked, I was like, holy S, he's right. And that sucks, right? That's the first feeling we have, is like, damn, we learned this and we feel like we've been a sucker. We're getting that dumb at the bank. But that's the truth of it. You're giving up 25 cents of every 30 cents you're paying right now for your first 5 to 7 years is going to the bank, not to you. So what Craig's going to show you is, what does this look like, right? This is the problem. What does this look like if you change where your surplus money is going first?
One thing here is when I talk to clients and I say, how much are you saving? You have to know where everything is going to even find out what you're saving. So I always keep everything checks and balances. I run everything through a credit card only because for checks and balances. So then at the end of the month, I always pay it off. But if you were to ask me in 2020, in December, how much gasoline did you put in your vehicles? All I have to do is just go right into the folder and I can come up with a number. Oh, I spent $678 on gasoline in December of 2020. In order to save, you need to know where is your money going first.
That's a beautiful point. And to Joe's point, like, think about it. If you go see a nutritionist, the first thing the nutritionist is going to ask you to do is write down everything you drink and everything you eat for 2 weeks. Because what does that do? That disrupts your pattern. It shows you, oh, I'm not going to eat this mini Snickers at midnight. All right. Like you start actually being honest. That's why I talked about taking radical ownership. So Joe's he's built a system into his habits that whenever he needs to know where something is, he can measure and monitor it. He can be like, why the hell we spent $650 in December driving? Where did I go? Oh, I drove Chris to Philadelphia, and then I drove him to Indianapolis, and then I drove to Florida. Oh.
And then we went to Michigan.
And I drive a giant Cadillac. So of course that makes sense. Like he can break that down. But what he said is so important. You have to understand first what is happening. What is happening on a day-to-day basis? And it's the same for anything, whether you're nutrition, spirituality, relationships, money, it's all the same thing. How do you take ownership of it?
Absolutely.
Yeah, and Jason, you kind of touched on the human problem. Nelson Nash talked about this. Do you want to hit this, and then let's just jump into solving some of these problems?
Yeah, let's solve problems. This is what I was talking about. Like, this is just, this is when your wants become your needs. Like, man, I really wanted a cold plunge, but now I need it because I made enough money to buy it, right? It's like when you let your wants become needs, and as you make more money, if you can't break the pattern of wanting to spend every additional dollars, like I was talking to a pharmacist earlier, and she was telling me about doctors who make $400,000, $500,000, $1 million a year. And they're like, I got to get paid because my wife wants to go on vacation, or I got to get paid because I got to, buy this new boat, right? Like, if you can't break that pattern, then you will forever be in the cycle. Like, this is the first thing that has to be overcome, is breaking Parkinson's law. So
Jason, I have something here. Whenever I talk to a client, I ask them, do you know the difference between a want and a need? Do you know what my answer is?
What is it?
If you don't have the money, you don't need it.
I like it. I like it.
Like
so that
that?
goes back to so that's your favorite, right? You ask him that question. I say, hey, here's another fun question. I don't think people really like where the majority of Americans live, but here's another one. What are the two pains in life? I'm looking in the chat. I'm looking at the Q&A. What are the two pains in life? Boil your whole life down to two pains. Lee's got death and taxes, fear and doubt, says Craig. Anyone else? Pain of discipline or the pain of regret? Simple. You choose. Pain of discipline, pain of regret. If you really know where you're going and you know what you want and you know the kind of life you want to live, you're going to pick discipline every time. If you don't have a plan, if you don't know where you're going, regret's a lot harder to live with when you get there. So Craig, bring us some solution.
Let's have some fun. So we've talked a lot about the debt, the national debt. We've talked about personal debt. We've talked about some of the issues, the Parkinson's law. We're not saving. Maybe we're putting the savings in the wrong place. What we're going to talk about now is a real use case. It's a use case, but it's a fictional person I call Bucky Doe. Bucky's got a whole family. He's got his wife, Saving Doe, daughter, Minnie Doe. They're a whole family, just like any American family out there. But they have debt. So we're going to figure out, how are we going to wipe out this debt? So let's go through it. So this debt profile.
Folks. By the way, I'm taking notes to this whole thing. Sorry, Craig, but take notes, write down your questions, write it in the Q&A, really learn, like be part of this. We can't see you. I'd love to be able to see you, but I can't see you. I don't know all the smiling faces that are there. I don't know what you're doing. I don't know if you have clothes on, right? You might be naked right now. I have no idea, but write down your questions for Bucky Doe and his family, right? Let's have Craig solve Bucky's life and take that anchor of a weight off of him.
So what Bucky shared with me is that Bucky's got a lot of debt. Some of this stuff crept up through different problems. They had some medical issues, incurred some medical debt, but things just got away from them. So they've accumulated about $99,000 of debt. And some of that comes in credit cards. You see some 29% credit cards, 27% credit cards. Of course, they have a truck, they have student loans, they got some education. So every month they're paying $2,166.14 of debt. So now what we want to do, we've classified, just like Joe was saying, if we don't measure and monitor, how can we fix anything? So Joe knows how much gas he spent 6 years ago. What we need to get better at is documenting so we know what our situation is. So here we go with Bucky Doe's debt. He's been documenting it, and this is what we have to work with. Now, the question is, how do we pay this off? Which way do we go? And so I'm just listing some options here. There are more options than what I have here, but isn't it true that we could stay the course? And what does that mean? That means that if we go back and look at his debts, the normal way of paying this off is we would pay these credit cards off. And once that $400 is done paying that credit card, what do we get to do with that? We got to go spend it on other stuff. That would be an option. We're just going to knock each of these debts down one by one. There's also a concept called snowball. And the whole concept of this is, as you pay one debt off, you take the sum that you were throwing at that debt and you throw it at the next one. Now, you could do that from the lowest balance to the highest balance. You could do that from the highest balance to the lowest balance. You could do that from the highest interest rate to the lowest interest rate. The question is, what do you do? Now, we could do any one of those things and add the infinite banking concept process to this mix, right? So what if we designed a policy for you that was going to be purposeful for paying down your debts? Phase one, we're going to pay down your debts. I'm sure there's many other options, but these are the ones that we're going to talk about today. And again, feel free to put questions in the Q&A or comments in the chat. So here's what we're going to do. We're going to look at what would life look like if Bucky Doe just continued to pay his debts off. 28 years. Bucky Doe and his family are going to be dealing with this debt for 28 years. They're going to pay on that $99,000 of debt. They're paying $164,000, and of that, $65,000 is interest. So to Joe's point earlier, these banks know how to play the game. They're getting almost as much interest in just the principal balance that we started with. So go ahead and put in the chat who wants to do it this way. Let's see how many ayes we have. Just put in there, I would love to pay down my debts this way. Okay. So we're obviously not happy with. Jason, would you want to pay your debts down this way? How about
No,
you, Joe?
this is how I was paying down my debt. Like I don't know about the other folks on this, but I was not as savvy as you and Joe. Like it took me a lot longer to arrive here. My 20s, I spent being a saver. My 30s, got married, ended up being a debtor, right? I've debt consolidated multiple times, and I've invested in things that I didn't understand, hoping for that big ROI that one day, someday. And so this is exactly what I would have been doing. Like I've paid myself out of debt twice, and then you end up broken air condition, broken car, something, right? And you haven't been paying yourself saving, and you end up back here.
Yep, always something coming up.
I stopped doing it this way back in 2009.
Like I said, you guys have been way ahead of the curve. So that's why you're here.
A couple days.
Just for a couple days. Now, what I want to show, and Chris talked about some debt pay down, I think 2 or 3 wealth webinars ago. I don't know how many of our folks on today were on that, but what I recall, there were some questions of, well, doesn't it make sense to maybe go after the highest interest rate first? Does it make sense to do it this way or that way? Here's the thing, audience, is it can depend. It's not always going to be a rubber stamp. But what I want to show in Bucky's situation, we're going to look at 3 different paths. One is, what if he pays his debts from lowest balance to highest balance? Meaning, we'll start with the credit card, the Chase credit card. Once that $1,200 is knocked out, you see he's actually making $35 a month payment to that. We're just going to throw that onto the American Express, and we're just going to keep knocking them down one by one. If he does it this way, instead of waiting 28 years, it's 28 years, all of Bucky Doe's family's debt is gone in 4.75 years. They're going to pay about $21,000 in interest as opposed to about $60,000. So this is a pretty decent option just by itself, just to snowball your debts, right? But I'm going to venture to say there's some improvements we can make on this. So I just want to kind of lay this out. This is a better option than just staying on the course that you were on. Now, what if we take the highest to lowest? I don't know if you're in numbers, but the actual time and interest went up a little bit. So I wouldn't advise Bucky to pay the highest debt to the lowest in this situation, because he's going to take a little bit longer. It's going to take a little bit more money. But what if he went and paid the highest interest? So we're going to start with that Wells Fargo card at 29.99%, work our way down to the Amex card at 27%, and keep going from there. Well, in this particular situation, and I'm just going to say, don't always just do it this way. Each situation can be different. But in Bucky Doe's situation, he's paying it off in 56 months, and he's paying about 20 grand in interest. So just from a snowball perspective, we have some pretty decent data here to give to Bucky Doe to say, this is the way I would do it. But I still think, is there a better way?
And the question for Everett Craig, that's awesome that you like the amount of genius you have to be able to create these spreadsheets. Joe and I can barely open our computers. All right. And I'm not, I'm picking on us because it's true, right? Like that's literally it. Like, and you've created to show people factually what happens. Like this is the pain of discipline. Bucky Doe can do it 3 different ways. There's more than that, but these are the 3 ways that you're exploring. and you're showing it this is the most efficient way. The question I want people to write down is, what is your money really doing? Like, what is that? That's the it depends part. Like, what is your money really doing? Like, if you look at some of these interest rates, you say, oh, well, that 29%, 12,000 is crushing him, right? But then you look and that's giving you $550 a month, and you look through each scenario, how much, because this is all about cash flow, how much cash flow are you getting back? Like that 0%, you might not want to pay that back before you pay back another one, right? Like, look at what are the cash flows. Just ask, what is the money doing? That'll help you figure out stuff without needing to do all the calculations to a degree.
So it kind of comes down to, I've always been very analytical, put the numbers on trial. So there's a lot of different approaches here. And I was kind of thinking through this, what if Bucky Doe had a personal loan and it happens to be from some guy that's going to break his kneecaps if he doesn't pay it back in a certain period of time? That might be the priority debt to pay off because he doesn't want his kneecaps broken. So all of these paths are subjective, right? We need to figure out what the best path forward is. So, if Joe loans me money and I don't pay him back, he might come and break my kneecaps. So I'm going to pay Joe back as soon as I can.
And we got to hop on our bikes and ride faster than Joe, because Joe's pretty strong, Craig. So
yeah. Now what we're going to do here, I'm just going to put the whole debt payment thing on pause for just a minute. Who here has heard of Chris Naugle's 6 Laws of Wealth? If you just put in the chat, I or me, I'm just kind of curious if you've been exposed to these before. Is it something you've heard before?
Some people.
Got some people that have.
We got I's and me's. Good job.
Yeah. Well, let's put it this way. What we're going to do is we're going to walk through the 6 Laws of Wealth, and I'm just going to ask for your patience because we're going to get back to the 6 Laws of Wealth, but I want to show these to you. The first one is pay yourself first. We all work hard. We make a lot of money. Shouldn't we be paying ourselves first? But if you're in debt, don't you think that's a struggle? If I'm in debt, how in the world am I going to pay myself first? That might be something you're thinking of. Number 2, and I would, go ahead and write these down if you would like. Number 2, we want to make your money work for you, right? We want to keep our money working. Joe talked about the velocity of money. We're going to keep that money moving. 3, Chris says all the time, if you're not first, you're last. And it comes from, what was that show with Ricky Bobby?
Talladega Nights.
Yeah. So if you're not first, you're last. We want to protect our wealth. That's the 3rd thing. The 4th one, and Drew had hit this by saying, don't expect high returns. But if you expect unrealistic returns, your money will flee you. Law 5, wealth shall find you if your heart and soul are focused on solving other people's problems. Isn't it true that if we solve people's problems and we're not focused on the money side of it, but if we focus the problems, the money follows?
I want to pause on Law 5 for 1 second. It's this one to me, like, I know paying yourself first means it's loving yourself first, right? God, self, right? Like you have to put on the oxygen mask first before you can help someone when the plane's going down. Same with if you're a lifeguard. Number 5 is saying it's not about me, right? It's never about us. How can we go out and add more value by solving more people's problems, right? And that's where you see the passion from Craig and this team is really, how can we help people have the freedom? Because we all want the same thing. We want more. We want freedom. We want more money, more time, more magic. So number 5 to me is the one that speaks to me, because when we flip our mind from saying it's about me, how can I survive? How can I survive? Versus how can I go out and help a bunch of people? And then that starts snowballing right into wealth, because that attracts it back to you.
Yep. Thanks for sharing that, because that's an important point. And ultimately, if we are focused on solving those problems, a lot of things just kind of fall into place. Be willing to share and pass on your knowledge. So if we know something, we should be sharing that knowledge with others. And whether that is within a circle of people whether that's on social media, whatever it might be, we want to be able to share information, right? And that's what we're doing here today, is we're sharing information. Now, I'm just going to ask you, keep these in mind. I don't know if you wrote them down, if you took a screenshot. We're going to come back to these. but I wanted to at least introduce them and refresh. As some of the people said, hey, like James, you said, hey, I know these, but please refresh my memory. So here we go. Refreshed your memory. The 6 laws of wealth. Now back to Bucky Doe's situation. So Bucky's got debt. We've seen Bucky's debt. We look at a couple of different options, how we can pay Bucky's debt down. So a lot of times what we start looking for is how can Bucky rearrange or maybe control of his money. One of the things that Bucky decided to do with his $150,000 a year job is he was contributing 8% to his 401k. He decided that he wanted to change that down to 3% just to get his company match. And as a result, yes, he paid a little more on taxes, but now he has $493.75 in his pocket that he takes home. Why did he do that? Well, we'll get to that in a minute. Now, Bucky's brother, he owns a laundromat. He's got a bowling alley. He's got a restaurant in town. And so Bucky, he loves spending time with his brother. He thought, well, why don't I just go down to the bowling alley, pick up some extra hours? And so he's been picking up about $375 extra a month from a side hustle. You know, he's got a full-time job. He spends some time with his brother at the bowling alley on, you know, the evenings and weekends. Now, Bucky has been saving money in his community bank account at a whopping 0.06%. So he has been putting aside a little bit of money. So when you add up the 943, the 375, the 300, Bucky actually has about $1,000, a little over $1,000 that he has available to use towards his debt. And what he shared with us is he wants to use at least 833 of that to pay himself first. So everybody's situation is different, but this is what we do every day when we're talking with folks, is just kind of ask questions. Hey, how much are you contributing your 401k? Does it make sense to maybe bump that down so you can get some freedom with your cash? So Joe, Jason, I mean, do you guys have anything to add on maybe other ways Bucky could find some cash flow? I mean, Joe, you talked a lot about HELOCs. Could we potentially use a 401k loan, a HELOC? You know, are there other things we could use to get money to pay down a debt?
Absolutely. You can borrow 50% or up to 50,000 of your 401k, and that you would pay the interest back to yourself by taking it out of the paycheck every week, by not contributing to an IRA that you were contributing to. There's a way to get more there. As simple as it is, just cutting out some coupons for some groceries can save you up to, you know, $20 to $50 a week right there. I mean, I was doing that in the beginning as I was on my way and saving money.
I would want to know, I mean, for me, I mean, from this scenario, this is going to be little bit out of the box, but like, what are Bucky's other talents? Like, I had a great argument with my father, right? Where he was like, retired from the county. At one point, he was an entrepreneur, a water well driller, but he retired from the county. And so we were visiting my wife's beautiful country in Ecuador, and he was like, I can't believe the price of gas and this, and I drive a diesel. And he was, you know, saying I'm so limited by my income. And I'm like, are you? And he's like, he got mad. And he's like, yeah, I'm limited. Like I'm like, Dad, are you? And I kept asking him, are you? Like, what could you create? Are you? And he kept getting mad and saying, yes, I'm in fixed income. I have this much. I can show you my budget. I can do this. And I was like, Dad, what about those Adirondack chairs you make out of skis? Like, you made them for my sister and I, and they're awesome. They're everyone that sees them asks me about them. You can sell them in Orlando for $500 to $800 a piece. So are you limited? Like, are you limiting yourself? It's your lack of resourcefulness. So maybe I'd like to know, can Bucky do something more than picking up extra hours as brother's bowling alley? Is there some other skill that he has that he can add more than 375, right? So that'd be the question I want Bucky to ask himself. How can he be more resourceful?
Isn't that the difference between a scarcity mindset and an abundant mindset?
1,000,000%. And that's why, like, I like that Joe said, use coupons, do this, because if you know what your why is, then you're practicing discipline. But at the same time, what I don't want people to hear is I got to scrimp and save and hope for one day, someday. It's how can it's go back to the laws of wealth, go back to number 5. What is it that you do really well that you can help others with and solve their problems? You could be a creative, you could be an organizer. Like, what is that thing for you? That's not what we're here to teach you, but that's just something to think about.
Well, I like it because it's getting out of the box. It's thinking other ways. How can we change our situation? Because you either stay in the status quo or we change something, right?
Breaking news, this just in. Are you sick of having your money lying around not doing anything? Well, we've got the solution for you. PrivateMoneyClub.com. Back to you, Chris.
Yes.
So Bucky's doing that. Now, what we're going to do for Bucky, we've talked about some different debt pay downs. We're going to design a policy for Bucky. Now, this is a specially designed whole life dividend paying policy from a mutually owned company. I don't want to get into all the numbers. This is a wall of numbers. My whole point with this slide is whether you talk to Joe, Jason, myself, we're going to help you with that process of figuring out how to design your policy for you, right? And in Bucky's case, he's going to put in about $10,000 a year. And our whole plan is we're going to use that as the place where we store our money before we put it into debts, right? So nothing real complex here. We're just taking that switch of that money that Bucky had, that $833 that he wanted to pay himself first. We're going to run it into the policy. It's going to compound and grow for the rest of his life. And then we're going to use
Stamp guarantee on that, Craig. Stamp a guarantee on there, because how many things in life are guaranteed other than death and taxes and change? That's my favorite three. But
whole life insurance policies.
Yeah. I know we sound like a bunch of nerds saying that, repeating that, geeking out about it. But when you really understand what we're trying to teach you and the light bulb goes on, you'd be like, man, why did I know about this before?
People only, their brains understand or. So when you said, take your $10,000 and put that into the policy and pay your debts. They don't understand that. The brain doesn't work that way, because usually when they have money in their hand, let's say $1,000, either they're going to take that $1,000, put it into their savings account, or put it into the stock market. They're going to take that $1,000, put it into the stock market, or pay their bills. Yep. This is an and product. They're going to take their $1,000, put it into the policy, and put it into the stock market, put it into their bills, put it into crypto. They have to understand the mindset. There's not too many things in life that's an and product. This is.
Absolutely.
Well done,
that's
Joe.
Beautiful. Now, I know there's a lot of people out there that probably look at that wall of numbers, as Chris calls it, the wall of numbers. He's always accusing me of sending him a wall of numbers, but here's a picture. And what I want to do is just kind of talk about the path of the money, where we're going. So as a reminder, we've got all of this debt, right? So how are we going to pay that down? Well, we're going to continue to pay those debts into the, the credit cards, the Chase, the Amex, the medical, the personal loan. But just like Joe said, we're going to take that $833 that Bucky Doe has set aside that he's going to pay himself first. He's going to simply put it into the policy. And what's the next word I'm going to say? It's that and word. And he's going to take that maximum loan and throw that at the third-party debts. So we're not talking about really any sort of complex process here. It's just simply flipping that switch where that money goes first so it can compound and grow. And then we're going to leverage it to pay down those debts. Okay?
Three things. And pay yourself first. And money not in motion does not make money. That would be laws 1 and 2.
A stagnant pond. So drum roll, please, because now what we're going to do is we're going to use the policy in addition to that snowball where we're going from highest to lowest interest rate. Because remember, we said that was the most efficient. We looked at going from lowest balance to highest balance. We looked at going from highest balance to lowest balance. And we looked at going from highest interest rate to lowest interest rate. So just as a reminder, this is what life looked like for Bucky Doe if he paid the highest to lowest interest rate. Now, what we're going to do is we're going to start throwing the policy money at it as in addition to this. So here we are, 56 months, about $20,000 in interest. Okay, so let's break this down. A lot of numbers here. So how long will it take Bucky to pay off all of his third-party debts using the policy and the snowball from highest to lowest interest rate? 42 months. So in 42 months, all of his third-party debt is gone. Okay. Now, we did take money from the policy, so we have a policy loan. Well, what are we going to do for the next 13 months? We're going to repay that and recapture our money. So if you look at the 42 months it takes to pay your third-party debts, plus the 13 months it takes to pay the policy loan, we're still debt-free by 55 months. We beat the other method by 1 month. We beat the snowball method only by 1 month. But you know what? This is not the exciting part for me, and it shouldn't be for you either. Who would love to pay off their debts and have $38,521 of cash value in their pocket, as well as $446,000 of death benefit? So the question I'm going to pose to the group is, who wants to pay off all their debts and have no money versus who would like to pay off their debts and have some money and death benefit?
Absolutely.
Anybody? Yeah. I mean, it's
so you want your cake and you want to eat it too, Craig. Is that what you're saying?
I'm saying it's an and thing. Joe pounded on the and thing. This is an and. We're paying our debts off and we're keeping money in our pocket.
I love the word and. That means more.
Yes. Yeah. So I don't see anybody in here yet saying they don't want to save money after paying off debts. And I saw Brent Kessler commenting here as well. I mean, he's got some great examples of how he did this, and he's got money in his pocket after paying his debts off.
And to give a quick timeline on that, I mean, rewind 14 years ago, Brent's a chiropractor with 5 offices in the Kansas City area. You know, he was probably practicing a little bit more regret than discipline with a lake house, a boat, a Sea-Doo, because if you have a boat, you gotta have a Sea-Doo, and a plane, right? Almost $1 million in debt. You know, like the example that we show, he paid that off in 39 months, right? Fast forward to today, his family, like I just learned this weekend, guys, the Kessler family has 32 infinite banking contracts. They have millions of dollars lent out because it's build, keep, and create more wealth. We're talking about to build your wealth from your debts and expenses today. But if you look, if you just do what the wealthy are doing, you too can follow that path. You can work like the bankers. Right now, today, they're lending out millions of dollars and they have mailbox money. Brent just goes to his mailbox every month. And he's like, woohoo! Right? That's it.
With a wheelbarrow.
Joe's doing the same thing. Craig's doing the same thing. I mean, that's what's possible. I'm not quite there yet, to be honest. So, but I've recaptured and now I'm keeping my wealth. So,
yep.
I love that game. Follow the leader. I love that.
Follow the leader. So I'm going to give this the winner circle here stamp. So this is what I would do, and this is what I've done. So let's move on, because what I want to show in the picture now, for those that are more visual, guess what? Our third-party debts are gone. We wiped them out. We blasted them out of our lives. Now we're going to take that $2,166, and what are we going to do with it? Well, in 42 months, we paid off all of the third-party debt. For the next 13 months, we're going to just rewire that $2,166 a month and put it back into our policy. At the end of this process, $99,000 of debt is gone, and you have $2,166 of cash flow that's now in your personal economy. How cool is that, right? We also have a cash value of $38,521 and a death benefit. So I'm just simply mapping out the numbers on the picture to help you understand that we're paying off third-party debts. We're going to flip the switch. We're going to run the money back into the policy. Within that 55 months, we have all of our debt gone. We now have $2,166 a month in our personal economy that we were throwing into debts that's now free and clear. Maybe it's time to start another policy. Maybe it's time to get into private lending. Who knows? But you have options now. So
the wealthy have options. All we did to go back, I mean, Craig's showing a wall of numbers. He's showing the benefits. He's showing the actual mathematical, the numbers don't lie. But really, all we changed was one thing. Bucky didn't make any more money, right? There wasn't any other changes. It's really, where did his money go first?
Yep.
And now it's not, we talk about all the time, it's the interest, the 29%, the 8.7. I'm going to also, submit that it's also the principal, right? Like I paid off 2 of our vehicles. It's $1,100 a month. There's only like $100 going to interest for those, right? Because they're both about 3 years in. We have 33 months left, or not quite. We have 33 months left to pay, but we're paying ourselves back $1,100 a month. That's real money. That's coming back into our wheel of wealth, right? So when you look at this, just know it's that cash flow number, that $2,166.14. And it's just because Bucky changed where his money was going first. And learn this skill. You got to learn and apply the skill too, folks.
Just what you were starting with, Jason. Not one time did Craig mention anything about interest rates or anything. Never once. Because when you turn up the volume, when you turn up the velocity, interest rates don't exist.
Joe, can you dive deeper? Craig's shaking his head. I believe I understand, but for everyone else, can you just give a verbal example of what you mean?
When you set something up on an amortized scale or for a length of time, it's done for the calculation of that time. If you add more to the principal, it throws the number out of whack. It can't keep up. That 7% or 8% mortgage that you were paying is not 7% anymore. As soon as so if you have $1,000 going to a mortgage, and just for the sake of argument, let's say 500 is going to principal and 500 is going to interest, and it's a 7% mortgage. If you start putting 600 or 700 to the principal along with that 500 to the interest, it throws that 7% mortgage probably down to a 4% or even a 3%. The flow of velocity changes all the numbers. And with the time scale that Craig was showing, I mean, it shows with the numbers alone.
Your interest charges go way down. The interest rates change because they don't really matter. They're funny. They're almost funny numbers. What I want to do now, we're going to shift back to, remember the 6 laws of wealth. And Jason, thank you for putting those in the chat. But for those of you that didn't get it out of the chat, again, law 1's pay yourself first. We want to make our money work for us. We want to protect our wealth. We don't want unrealistic returns. We want to be focused on solving other people's problems. And we want to be willing to share and pass on your knowledge. Why am I bringing this up again? Well, here's why. Let's go back to this picture. How do those 6 laws of wealth relate to what we've talked about today? Would you agree that if Bucky Doe is putting in $833 into his policy, is he in fact paying himself first?
Absolutely.
Okay. So have we adhered to law number 1 of the 6 laws of wealth?
Yep.
If we put our money into a policy, and this is what I want to talk about, is everybody's state is a little bit different. There's protections of cash value in whole life policies, varies by state, but the creditors and predators will have a lot harder time getting your cash value. So if I had cash value in my policy versus money sitting in a bank, the money sitting in the bank is a lot easier to come and grab. So have we in fact done some level of protection of our wealth by putting it into the policy?
Yes, we have. And it's guaranteed, Craig.
Joe, I'm going to change your name to Andy.
I don't know.
When we talk about the law making your money work for you, this is the and again, because while we're putting money into the policy, what is it doing while we're using it in debt pay down? What is it doing? It's growing compound interest, right? It's
Absolutely.
earning, yeah, Will. What else Will, what else does it earn? There are non-guaranteed dividends, but what else does it get? Anyone put in the chat, what else do we get in addition to the non-guaranteed dividends? Compounding, tax-free growth, all of those things, right? Death benefit. And that takes me to my next one, which is
protection from liens and judgment. Did you already say that?
Yeah. So be willing to share. What do I mean by be willing to share? Well, let's say that Bucky Doe is driving home from his bowling alley job at 1 a.m. because he was helping clean up, and something nefarious happens to him and he passes away. Is he not able to take, is that death benefit in his policy not going to benefit his family in a major way? Is he not willing to share by paying himself first? Is he now willing to share to make his family, put his family in a better position? So that's why I say that having money into your policy is you're also being able to share with your family if something happens to you, right? Or to whomever you want to share it with. Now, this other one, solving other people's problems. Let's think about this one. What are one of the top 3 reasons for divorce? Go ahead and put in the comments in the chat. What are well, marriage, of course. Yeah, Will, we got, that's perfect.
Well, that's an awesome
Marriage.
answer.
You are correct.
Yeah, if you do get married, that could be a cause. Financial challenges, money. I mean, how many people fight over money? How many people have arguments over money? So I'm going to venture to say that if you take ownership of the debts in your family and you pay them off, that could potentially put your family in a better position. It could put your children in a better position. So I'm just saying that this could be another extension of one of the 6 laws of wealth of knocking out your debts. We will solve other people's problems in our family if we can get this third-party debt out of our lives. Before we move on to this next thing, what I want to do is just kind of talk about the flow or the phases that we go through. So when we get done paying all of our debts off, what are we left with? Well, we're left with $2,100 of additional cash flow that was going to pay down debts that we don't pay anymore. We have this cash value sitting in our policy. Joe, what can we do with this?
Oh, gee. Should we find an investment and make more money with our money?
Oh, wait a minute. So you're telling me that all this work I've spent for the last 4 or 5 years of paying down my debts and I have this money captured, I can go make more money with that?
I think that would be a great idea.
Well, you took the words right out of my mouth. So what we really want to do is we want to use that money again. Oh, wait, there's that and word. We want to use the money again and grow our wealth. Whatever your particular investment is, Chris always talks about what you know, like, and understand. If you have a policy and you've paid down your debts and you have cash value sitting there, you can take that money now while it continues to compound and grow. So we're going to and the money again into something like a private money club deal, a private lending, something along those lines. So now what have we done? We've not only cleared out debt, but now we're building wealth. And we're just going to keep this perpetual machine going where, let's say, for example, you're familiar with private lending. You might put your money into a private lending deal. That's going to pay you a monthly interest check that comes back into your segregated account. You might either pay some of the policy loan interest. You might reinvest. There are options scattered all over this chart. It doesn't have to be private lending. It could be pretty much anything you know, like, and understand. I talked to a guy recently that's looking at building a business around ATM machines. Another one wants to build a recreational quad ATV business. So there's so many cool ideas out there. So this box that says private money club could be whatever your investment strategy is.
So does that mean
now
we're making money twice, Craig? Once inside the policy and twice inside the investment? Is that an and again?
Well, yeah, so $1 is making money in multiple places. Wow.
Exactly.
So this is really a great example of making your money work for you, right? Are we not making our money work for us? And we're making it work even harder. We're not just going to let it sit in the policy. We're going to put it to work. We're going to deploy it.
Joe has one thing on his wall, folks. It says, what's it say, Joe? The one thing that's not on that wall, but the wall in your office. One sign. What's it say?
Go ahead, tell
It's your wall.
him.
You probably can't read it, folks. I'll read it for him. Money never sleeps, right? We got to sleep.
Money never sleeps.
Joe doesn't sleep much. He's out there serving, but the rest of us, we got to sleep. I go to bed like 9 o'clock, right? So
yeah, Joe, I think it was 10 o'clock your time. I was on the phone with you, 8 o'clock my time, and I think you were falling apart. You were pretty tired.
I was done. Yesterday I was done.
So the next one I put on here is going back to the seeking unrealistic returns. So why I put this on there, and I would say this applies to a lot of the folks in our community. If you're in private money club, you're private lending, just go ahead and put in a I, just so I know kind of what we have here, or if you don't know anything about it, that's fine. But I'm kind of curious who all is our private lenders with us today. So we have Will, okay, we have Mark, Jim, Leah. That's awesome. So why do I like private lending? We have Don. Yeah, so wow, we have a lot of them today. That's awesome.
That is awesome.
When we do private lending, oh, go ahead. I'm sorry.
No, I just said good job, all. That's amazing. That's awesome. I love seeing
awesome.
eyes and me's. That's cool.
Yep. So when we put our money into private lending, we're just acting like the bank. We're putting our money into assets that are collateralized that have potentially more, should have more value than what we're investing in. So are we seeking unrealistic returns in that manner? No, we're actually protecting our money. We're putting it into a safe investment and keeping it working. The next thing I wanted to talk about as well is when we do private lending or we do investing, I don't know if anybody else thinks of it this way, but I want to share just a quick story of one of the guys I work with on, he's a real estate investor. I loan money to him. And I specifically asked him when I first met him, I said, what are you trying to accomplish with your business? And he told me, he said, so Craig, what I'm trying to do is I want to clean up the cities that I live around. I want to provide affordable housing for people in my communities. So we had all these other focused perspectives. And so I thought, well, how cool is it that I can loan him money and I can gain from that? When I loan him money, he makes money for his family and he's helping to put people into homes that are affordable and clean. So how cool is that we're focused on solving people's problems and everybody's kind of sharing in some of the wealth? So I think with this particular law, that kind of hits home pretty hard for me, is that we're so focused on solving other people's problems. He needs money to buy more houses. People need more houses to live in, and they need to be clean. So Joe, Jason, I don't know if there's anything else you want to say on this, but this was just one to map some of these.
No, one of the things, Craig, I love that. You just basically said, listen, you're talking to someone that has a bigger why, and it's something that's making a positive impact on the communities. And at the end of the day, like, I didn't know any of you guys a year and a half ago, right? And I didn't even know about Chris Naugle a year and a half ago. But because of my vision and because of when I read Nelson's book and said, this can't be true. Like, how the heck is this true? And I read it again. And my mission was like, money's not that complicated. I ran away from it for 46 years. And I started going out and how can I help other people understand what I was lacking to understand, what was hidden from me? And then that energy, this is my belief. Let's give me chills a little bit. But my belief is that energy, when you solve people's problems and you really do it from the right place, you end up with like-minded people. So what Craig's saying is, how cool is it? Like when you put your money in a 401k, or even if you put it in crypto, or you put it in something else where you don't necessarily understand what's happening with the money, to me, that's not very exciting because I'm a people person. So I want to know if I'm lending to someone or if that's what I'm doing, that they're using that to make something positive. It's people helping people. It's real people helping real people. You vet these people. You do learn this. You got to learn this like anything else. Don't go out there and be like, oh, I want this deal because it gives me this giant ROI. Then you're just doing the same thing. You're gambling. You don't understand. You don't know, and understand it. Right. But I'm saying like people helping people heart to heart. That's what gets me up in the morning. That's what keeps Joe up half the night all the time. Joe wants to help everyone and he has no boundaries, but Joe will get there. Right. He needs to know it's a long haul.
I do try. I mean,
you don't try, you do. What would Yoda say? Look at him. He's back there on the wall telling you all the time, do or do not.
Well, and I like a lot what John put in the chat here. It says banks don't focus on helping servant investors like that. So it's just banks are all about the money, right? If you don't pay your bill, they're coming to get you. So it's just a different perspective. Private lending, it's meaningful to me, just like what Jason's talking about. It's meaningful because you're putting your money to work. You're doing all the right things in the 6 laws of wealth, and multiple people are getting helped with this. So I just love this whole plan. I know we've got about 15 minutes left.
Wow.
I'm going to finish up with well, here's the thing. I'm going to finish up with something that I want to share with our community. And when we're done with that, just let it soak in. And I know there's a lot of questions that we haven't gotten to. So what I'd like to do is share what I'm going to share, and then let's go back and do some Q&A. We've covered a lot of ground today. We've talked a lot about how we can pay down debts, why it's meaningful to pay down debts, what we can do after we pay those debts off. You might have to go look this up, but if you've ever heard of the parable of the sower, it's in Matthew 13. And essentially the story behind it is Jesus was out teaching, and there was such a multitude of people. He went out in his boat, and he was talking to people on the shore, and he was talking about his message, how his message sometimes falls on the ground. People just don't even hear it. They don't do anything different. And he goes through these different iterations. So I'm not going to read that story to you. If you're interested, go check it out. But what I want to share with you is what Jason and Joe and all of us on this team, what we deal with every day. And sometimes it's tough because we see someone's problems. We know what the solutions are, but the seed just doesn't grow. And here's the story. Here we go. So behold, a money mentor went out to reach the multitudes to take back control of their money. Some heard with lack of discernment and continued to live the status quo. Some heard the message, understood it, and planned to implement the process in their life. Their family, the financial entertainers, their financial advisors, and others told them it's a scam, and it choked out their progress. However, some heard the message, they understood, they built a strong foundation, and they yielded a crop of success that wiped out third-party debt, capitalized their own system to fund the things they need and want, while building a legacy for generations to come. So let me ask you, Wealth Webinar community, for those who have ears to hear, let you hear, let them hear. So with that, I'm going to let that soak in. I hope this has been worthwhile for you. I really urge you to take action and listen to what we're talking about. Think about the parable of the money mentor. This is what we deal with every day. We're trying to solve people's problems.
That was really cool, Craig. That was really cool.
Thank you.
That was incredible. Thank you for sharing that, Craig. I loved it. And this is what keeps me personally up at night. Like, I started dreaming about this, and I was a little upset I was dreaming about it. I'm like, why am I dreaming about conversations I'm having and having a solution for someone? And it's, if you have children, you'll understand this, right? Like I see the patterns and the habits that my 20-year-old have, and he's gotten better on some of them. You lead by example as a parent as much as you possibly can, but no matter what, they're still their own individual. He still has to see it for himself and do it for himself. Like, you can bring a horse to water, and you can stick the horse's head in the water, probably drown a horse half the time, right? We don't, that's not what we're looking to do. But this to us is like, look, there's not a person, including the application specialists, including the people that are the data input specialists, that aren't practices on the team. That's what I meant by we attract like attracts like, where you come back and you're really looking to help people, and you're teaching something that you're practicing, the legacy piece. So I love what you said, Craig, because it's literally what we think of every day, and you bring it back to biblical terms, and it makes it more powerful. So.
Well, I appreciate that. And with the next 15 minutes that we have remaining, I think we should just get back to some of the Q&A. If anybody wants to go back over anything that we've talked about. I'm
failing at Q&A. There's 14 of them open, and I've only answered 5. I've been going at it, but I could use some help.
So
by the way, if you don't get it answered, AMA at 4:30 today, quick plug. Yeah. We'll all be on there answering any questions you guys bring to us, banking related, fishing related, whatever you bring. We'll answer the questions the best we can. So, and by the way, disclaimer, it's almost an hour into this, hour plus. We are not financial advisors. We are not attorneys. We are not tax professionals. We are none of the above. We are simply here as servants, teaching, mentoring, helping people break their financial bonds of slavery. So,
and as I tell my
Amen.
clients, I'm a money mentor. I only tell you what I have done, did, or currently doing. That's it. I don't blow smoke, and I'm not a financial advisor guessing.
I heard a guy say one time he doesn't have a license to lose your money. And not to take digs at people, but just what you're hearing here is that all of us on this team, we are practitioners. We are doing what we're telling you. We're doing the same things, right?
this is what happened, Craig. I'm
telling
going to
you-
bring on a special guest.
Oh no.
I love this.
Folks, this is if you haven't met him yet, this is Chick. He's my financial advisor. I told him that I was starting my IBC to take back, control of things. And this is what he said to me. It was really hard to hear, but I want you to hear it too. That's what people, your family, that's what everyone sounds like when you tell them you're going to start practicing IBC. They sound just like Chick here. It's a fact. I've seen it. It's ugly, but it happens.
Well, let's get to some of the Q&A. This has been great, but I do want to answer some of the questions. So just kind of filtering down. So there was a question for you, Joe, which bank you represent. I think the question is, what bank do you recommend?
For HELOCs? For HELOCs,
I think it's HELOC.
Okay, yeah. For HELOCs, it's First Savings in Tennessee. I'll go over all of your numbers with you if you give me a call, and we'll see if it'll be a good fit and consolidate your debt. And then we'll do a three-way call with the bank and talk to them personally and get the process rolling.
Yep, awesome. James asks if we've ever broke it down from the highest monthly payment to the lowest monthly and vice versa, lowest monthly to highest monthly. So James, we have the ability to do that. So I've been working on a tool that can do that analysis, can slice and dice and carve. What I found through doing a lot of these in practical use cases is sometimes, and I'm surprised, sometimes I do it one way for a client and it's actually beneficial for somebody else to do it a different way. So it really comes down to the debt volumes, the rates that you're dealing with, the amount of money you're putting towards those debts. But any of those ways can be practical. So I can't give you a rubber stamp answer on which one always works.
I think more importantly, Craig, I love that. Craig's really diving in, improving the math, which is not a common thing. Like he's doing a project that has 18 tabs. It has a ridiculous amount of complexity. But at the end of the day, this is a super simple process. I'm an artist first, right? Like I realized once I got to calculus in high school, okay, I thought I was really good at math. Not as much when it becomes theoretical, but if you can add and subtract, multiply, you can figure out how to do this. You can just learn a new skill. Remember, two jobs we have to have, one of making money and then the one of being a banker, right? So if you're a business owner, you're adding a banking branch. I say this all day, every day. If you're an employee, you're opening your first business as a banker. It is understanding that process of moving the money. So if the difference is $1,000 over that 39 months, I'm just going to say it. Who cares? Who cares? It's principal and interest you recapture, whether you went low to high, high to low. That is just the analytical in you. You got to learn the process first and you got to take action.
So one of the things I see, Joe, thanks for posting your information. Jason, do you want to put your contact in there, and I'll put mine as well, just in case people have specific questions for us?
You can just call Joe, and then he'll tell you my number. No, just kidding. Yeah, I'll put it in there.
Joe doesn't want to be the gatekeeper, but yeah, feel free to reach out to any one of us. I mean, we're all on the same team. We can all help you with different aspects. So just feel free to reach out.
I'll tell you why I'm not putting my email, even though you might want to email me. I have 57,392 unopened emails. So you should text me. I'll text you back.
So Nicholas was asking, he said he'd be interested in seeing how much faster Bucky could pay off the debt using the cash flow index. And Nicholas, I think we talked about this a little bit, and I haven't really built that into the model, but yeah, there's some new cool things we could do down the road.
Nicholas has had great comments throughout. So thank you, Nicholas, for your participation, both in the chat and in the Q&A. Really good insights. And a lot of really exciting. It's excited to see others who are practicing this, learning this, here to learn more. Another thing you might want to write down is just if you haven't started, if you're learning about this, there's so much. We give away our best stuff for free educationally, right? So go out, look for what you want to know about, whether it's HELOCs or real estate investment or just the IBC process. Go to chrisnaugle.com, right? Check that out on his YouTube page, learn about it, but then just give yourself permission that you don't know this yet. It's like any new skill. If you're just starting, it's going to seem weird. It's going to seem like it can't work, but you just don't know it yet.
Yeah,
Other
Robert
questions?
mentioned that he's been trying to educate his friends about IBC. They just don't hear him. So unfortunately, that's just the case. And that's why I end up putting that parable of the money mentor together, because really that's the reality of it. Our friends, our family, sometimes the people we want the most to be educated on this just won't listen. So, we can't stop doing what we do, but it is what it is. Brian, hey, Brian, good to see you out here. Brian's asking if the math works if you do a policy loan and use it to reduce a HELOC balance. It can. And, Joe and I talk about this a lot. Both Joe and I have first lien HELOCs on our properties. And it just sometimes depends on how the money's flowing and how you wire it together. But yes, it can be beneficial. I'm currently running at about a 3.84% on my HELOC. So I have a lot more flexibility than someone that might have a 7 or 8%. But we can always run the math and take a look at it.
How do we set up a policy? You can text any one of us. That's Carl's question, right? And I would say, again, I'm inviting everyone to know what it is that you're solving for, whether it's debt, whether it's setting up kids for future college funds, whether it's parking and protecting lazy money, whether it's investments. Like there's typically 5 or 6 different, did I miss any guys? 5 or 6 different common problems we're solving or opportunities we're solving for folks. And people say, well, hey, I don't have debt. I don't need this. You don't, right? It's an and asset, right? The guy taught me owns 40 wealth management offices and calls it the and asset and has his money leveraged. Every single policy is leveraged into something else that's in a risk bucket. So you want to run it through a guaranteed bucket and then have it go into your risk bucket. That's the way I think about it, because I'm very risk averse. So
there's one thing, I know we don't have a ton of time, so I could probably run through this real quickly, but Nicholas, on the last question I see that we have is, there's now one more, but Nicholas is asking about an in-depth look on paying back the loans and what I can do just real quick, like.
So when somebody says, well, what happens if there's a loan on the policy? Doesn't that get minus from the death benefit? And I says, it does, but let's back up a step. Yeah. Let's say I'm 80 years old and I have a $2 million death benefit. And I have I have a $2 million death benefit and I have $1 million out on a loan, but that $1 million is lent out to Craig and he's paying me $10,000 a month for it in interest. And I graduate, I pass away. Well, Craig is still going to be paying that $10,000 a month, even though I'm not alive, to the bank account where it's still going. Not only that, what happens if my beneficiary, after 3 months that I'm gone, calls up Craig and says, Craig, I want my principal back. And then Craig gives my beneficiary the $1 million. Well, they already got the $1 million when they received the death benefit minus the cash value. And now they got the other $1 million. Did they not get the entire death benefit back? They did.
They did. And I appreciate you going through that, because what I was going to do, a lot of people ask about the loans. And what I've done is I've broken it into these different buckets. So we want to think about how the loans work. So remember when Bucky Doe is putting in the 833 into his premiums, guess what? That number just keeps growing every year, every month, every day. It just keeps growing and growing. Now there's this other thing called cash value. That's going to be the gauge. And I've got a little gas gauge here. Guess what happens when you drive your car? Well, you use gas, your gas gauge goes down. When you use your cash value, the available cash value goes down. When you pay your loans, the available cash value gets restored. Now, the cash value is simply, as Joe was talking about, is an advance of the death benefit. So the insurance company is advancing you cash value to use. But the loan itself comes from the general fund of the insurance company. Okay, so that's where our money is actually coming from, not our own policy. So a lot of people ask, how does the loan work? And I just want to run through this real quick because a lot of people benefit from understanding how these loans work. Let's say you take out a $10,000 loan and the interest rate is 5.24%. If you don't pay anything on that loan throughout the year, look at the interest down here. It's $524. That's 5.24%. So not real hard to understand. We take out 10,000, we're going to pay 5.24% on it. But here's where the difference comes in. What if we pay $500 a month towards that loan every month? Well, the first thing you'll notice is 100% of it goes to principal. Unlike an amortized loan where 50% or 70% goes to interest, 100% is going to pay down the principal. Now, remember when we weren't paying anything back? Our interest balance was 44, then it was 87, 131. Well, look what's happening as we pay it down. We're buying the interest down. So that's pretty cool. So at the end of the year, we actually end up paying less than 5%. But we also need to remember, as we're paying our loans back, $500 goes back to fill up our cash value, then 1,000, then 1,500, so we're putting that back in that we can use again. So there's a lot of cool things going on in the loan repayment. But the question is, if it's a 5.24% loan, did we really pay 5.24%?
Oh, this is awesome. Yep. Absolutely not. Bingo.
And Joe, you were talking about the velocity, the money moving, buying down the interest. This is what's going on. So we actually bought that down to 3.54% using that money.
And that was only in 12 months. Look at, you dropped it. What is that? 1.5%? In 12 months.
5.24 to 3. Yep. So by being an honest banker, you actually saved yourself $170 of interest.
And if you paid it back, like if you paid that 10,000 back, because I like simple math, right? Simpler. If you paid it back in half the time, you only use the money for 6 months, you're only paying half the interest. Right. So
and to that point that Jason's making, now if we pay it back in the year, we're actually paying 2.4%.
Yes. So again, what is the money doing? Ask yourself, what is my money doing? Start asking yourself that all the time, because I can tell you right now, I'm still learning what my money's doing. I don't always know, but when I start asking myself, what is my money doing and how much cash flow is it bringing to me? Those are 2 questions that have really changed how I work with money.
If people were walking into the bank when they wanted a mortgage and didn't ask, what is the interest rate I'm paying? If they asked, what is the velocity that I'm paying? They wouldn't get the mortgage and they'd turn it around and walk out of the bank. Exactly. That was awesome, Craig. And that was only in 12 months. Perfect.
12 months. Yep. So the last question, and I think we'll wrap up because we're at time, but Carl asks, can we switch a regular bank mortgage to a HELOC?
You most certainly can.
Yes. So you might want to research a thing called a first lien HELOC, an all-in-one. They're all similar, but essentially it's a regular mortgage. It's a 30-year mortgage on your house, but it's a simple interest first lien HELOC. They typically put a little checking account on top of it. Allows you to get the money in and out. That's what Joe and I are doing.
Yep.
So with that, I appreciate everyone showing up. I love the engagement, the comments, the questions. I know we can't get to every single one of them, but we're at time. I want to be respectful of everyone's time. But guess what? We're all back at what time, Jason?
4:30 Eastern, 2:30 Mountain Time, 1:30 Pacific Time.
In 2 more hours.
3:30 Central Time. So wherever you are in the United States, we are on in just another 2 hours. So,
all right. And if you don't know how to get to the Ask Me Anything, you can find it through the link to the YouTube channel. It's on the Infinite Banking Facebook group. So there's some different ways. If you've never been to Ask Me Anything, love to have you join.
It's fun. Joe will bring a drink. I won't because I have something to do later, but come have a drink with us. It's happy hour. Ask Me Anything, AMA, happy hour. Come have some fun. Thanks you for being here. We had over 130 some people here learning about this. I think that's incredible. Craig, you rocked it. Thank you for letting us support your brilliance today. Joe, same. Thank you for being here to support. It's been amazing, guys.
Good job, man.
All right. Thank you all.
Thanks, everybody. See you in a couple hours.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.